Inflation has cooled. The Federal Reserve's own data confirms it. The Consumer Price Index has fallen from 9.1% at its peak in 2022 to approximately 3.8% today. Every major financial outlet is reporting it. Every government press release is celebrating it. And yet, 7 in 10 Americans say they are still struggling to pay for food, housing, and healthcare. The same 7 in 10 who watched the inflation headlines improve month after month. The same people who heard that inflation was coming down and went to the grocery store and felt nothing change. So what is going on?
Are people wrong about their own financial situation? Are they misreading the data? No. They are experiencing something real. And the reason it feels like a contradiction is that inflation cooling and prices falling are not the same thing. They are not even close to the same thing. And nobody in the financial media is clearly explaining the difference. Today, we are going to fix that.
Here is the most important thing to understand about inflation, and it is something that the headline number completely obscures. Inflation is not the price of things. Inflation is the speed at which prices are rising. Read that again. Inflation is the speed, not the destination, the speed. Think of it like a car on a highway. In 2022, that car was going 90 miles per hour. Prices were rising fast, brutally fast. The 9.1% CPI reading was the speedometer showing 90. Today, the speedometer reads 38. The car has slowed down significantly. That is real. That is what the Fed accomplished. That is what the headlines are celebrating.
But here is the thing about a car that slows from 90 to 38 miles per hour. It is still moving forward. The car has not stopped. It is not reversed. It is still covering ground. Every mile it travels at 38 miles per hour is a mile it does not come back from. The distance keeps accumulating, even as the speed drops. That is exactly what is happening to prices. The rate of increase has slowed, but prices are still going up. And every price increase since 2020 is still in the system, still in the grocery bill, still in the rent check, still in the insurance premium. Slowing down is not the same as going back.
Now, let's look at the actual numbers, because the numbers tell a story that the CPI headline completely hides. Since 2020, grocery prices in the United States are up approximately 25%. Housing costs are up over 30%. Utility bills, the electricity and gas that heats and powers your home, are up 12% in the last year alone. Car insurance has risen nearly 50% over 3 years. And healthcare costs continue to inflate at roughly 1.5 to 2 times the general rate. Now, the inflation rate is 3.8%. What that means in practice is that the prices which already rose 25%, 30%, 50%, those prices are now rising an additional 3.8% per year on top of where they already landed.
Your grocery bill did not go back to 2019 levels when inflation cooled. It stayed where it was in 2024, 25% higher than 2019, and then went up another 3.8% from there. The baseline shifted permanently. The inflation rate came down, the price level did not. And that distinction between the rate and the level is the most important thing to understand about why 7 in 10 Americans feel like the situation has not improved, even as the headlines say it has. So why do prices not fall when inflation cools? There are 3 reasons, and all 3 are operating right now. The first reason is that prices are naturally sticky downward. In economics, price stickiness means that prices resist falling, even when the conditions that cause them to rise have passed. When a business raises its prices, it almost never voluntarily lowers them afterward. Not because businesses are uniquely greedy, because the incentive structure does not reward it. Think about it from the business side. If your costs go up and you raise prices, your customers are upset, but they adapt. They keep buying because they have to. If your costs then go down and you lower prices, Your customers are briefly happy, but you just gave up margin you were successfully capturing. Most businesses choose not to do that. The price stays where it is. The result is a ratchet effect. Prices move up when costs rise. They stay up when costs fall. Each inflationary period permanently raises the price floor. The second reason is corporate profit margins.
During the inflation surge of 2021 to 2023, many large American companies did something interesting. They raised prices faster than their costs actually increased. They used the inflation environment, when consumers expected prices to rise, as cover to expand their profit margins. Economists called this greedflation. The data showed it clearly. Corporate profit margins hit record highs during a period when consumers were supposedly being squeezed by inflation. Both things happened at the same time because companies were passing through more than their actual cost increases. Now that input costs have stabilized, those inflated margins are still there. Companies are not rushing to give them back. The prices that were raised beyond cost increases are not coming down. The third reason is that real wages have not recovered. Between 2021 and 2023, inflation consistently outpaced wage growth. Workers earned more dollars, but each dollar bought less. Real purchasing power declined. Workers fell behind. Since mid-2024, nominal wages have been growing faster than inflation. That is good news, but it does not erase the ground lost between 2021 and 2023. Workers are gaining back purchasing power slowly, but they are starting from a position that is already significantly behind where they were in 2020. Inflation cooling does not restore the purchasing power that was lost. It just stops the bleeding. The wound is still there. So come back to the original question. Inflation has cooled. Why does nothing feel better? Because inflation cooling is a story about the speedometer, not a story about where you are. The car slowed from 90 to 38. That is real progress on the speed. But in the time it was running at 90, it covered a lot of ground. Grocery bills 25% higher, rent 30% higher, insurance 50% higher. That ground does not disappear when the speed drops. You are still there, on that road, at those prices. The financial media reports the speedometer. They tell you the rate is coming down and frame it as improvement. And in a technical sense, they are right. Inflation at 3.8% is better than inflation at 9.1%. But what 7 in 10 Americans are experiencing is not the speedometer. They are experiencing the accumulated distance, the prices that did not come back, the purchasing power that was not restored, the paycheck that still does not stretch as far as it did in 2019. That experience is not irrational. It is not a misreading of the data. It is a completely accurate description of what happens when prices rise sharply and then stay there. The inflation rate is a measurement of how fast the problem is growing. It is not a measurement of how big the problem already is. And until wages recover enough ground to close the gap that opened between 2021 and 2023, which takes years, not months, 7 in 10 Americans are going to keep feeling exactly the way they feel right now. The financial media will not explain it that way, because explaining it that way requires admitting that lower inflation is not the same as financial relief. But that is exactly what this channel is here to do. If you want to understand the economic forces that shape your financial life, not the version that fits in a headline, hit subscribe.